Bitcoin just suffered the largest dollar value crash in its history, and it happened in a market that's supposedly institutional now. There was no exchange failure, no fraud, and no black swan. Gold and silver absorbed the debasement trade over the past year, and Bitcoin broke down. So if nothing actually broke, what caused such a violent move? Today we're going to unpack the most compelling explanation, a derivatives-driven unwind caused by Bitcoin's new market structure, and why the same mechanics that forced this crash can just as easily fuel a violent upside gamma squeeze next. Because every time fear peaks, the obituaries come out, Bitcoin is underestimated, and time is a flat circle. You already know what happens next. Welcome to No Second Best, the show where conviction meets reality, and reality still points straight to Bitcoin. I'm your host, Hurley. Now let's dive in. Last week's move wasn't just another drawdown. Bitcoin experienced the largest nominal crash in its history. Not the biggest percentage drop, but the biggest raw dollar move ever. For context, if you didn't sell here, you just survived the 9th worst crash in Bitcoin's history. Congratulations. It also marked the 9th time Bitcoin has fallen roughly 50% or more from its peak. Painful, yes, but definitely not unprecedented. What was unprecedented, however, was the context. Historically, Bitcoin crashes of this kind of magnitude come with a clear narrative or villain. Mt. Gox, one of the many China mining bans, or fraudulent exchange collapses like FTX. This time, there was nothing obvious. No protocol failure, no exchange blowup, no smoking gun. And the absence is exactly the clue. When there's no headlines to blame, you're forced to look deeper, not at narratives, but at market plumbing. The most coherent explanation for this move, of course, did not come from the mainstream media. It came from Jeff Park and Parker White, who independently laid out a detailed thesis on X explaining how this unwind likely occurred. I highly recommend checking out both their detailed write-ups on your own time. What I'm going to do here is translate this thesis into plain English and then explain why it's not just bearish, but potentially very bullish. First, we need to acknowledge something fundamental. Bitcoin is now over a $1 trillion asset. It's still small in global terms, but it's crossed the threshold where it can no longer be ignored by institutional capital. And for the first time in its short history, it has numerous spot ETFs, options on those ETFs, structured products, dealer hedging, and market makers deeply involved. And that matters because economic exposure to Bitcoin can now be created without touching Bitcoin itself. These are paper claims, not on-chain Bitcoin. While they don't change Bitcoin's supply, they do change short-term price behavior. Large multi-asset funds don't trade narratives. They trade correlation, volatility, and risk limits. When correlations across markets spike, tech stocks, software, growth, risk assets, risk managers have to step in and de-risk. Bitcoin in these portfolios is still treated as a high beta risk asset. So it gets sold not because someone changed their mind about Bitcoin, but because the math demanded it. And now add the second layer of options. When large options positions exist, dealers have to hedge. As price falls, hedges force more selling. That selling pushes price lower, which increases hedge requirements. That reflexive loop is called a gamma squeeze. And in this case, it was to the downside. And this is the critical insight. The selling was not directional conviction, it was obligation. That's why the move felt so violent and so emotionless. Here's the part that matters most. During the chaos, ETF trading volume exploded and options volume hit record levels. But ETF holders didn't meaningfully redeem. Long-term capital stayed put. That tells us something crucial. The epicenter of this crash wasn't retail panic. It wasn't long-term conviction breaking. It was derivatives unwinding in the paper Bitcoin layer. When you strip the data down, the message is actually pretty clear. This was a market structure event, not a crisis of conviction. And this is exactly where perspective matters. Because if this move wasn't about conviction breaking, then the real question becomes how serious holders should think about Bitcoin through volatility like this. And that's where Swan Private fits in naturally. Swan Private is built for individuals, families, and businesses who already understand that Bitcoin isn't a trade. It's a long-term strategic asset and a means for building generational wealth. And what follows that conviction is disciplined accumulation, thoughtful custody, tax-aware structuring, and making sure that Bitcoin actually survives across generations. No trading, no leverage, no noise. Just a Bitcoin-only advisory team that helps serious holders stay aligned with long-term conviction, especially during moments like this. For more information on products and services offered to Swan Private members, visit swan.com/nosecondbest. And that long-term lens is important, because when you zoom out, Bitcoin clearly isn't breaking, but it is still profoundly misunderstood. Throughout the debasement trade, gold and silver caught the bid while Bitcoin didn't, which suggests Bitcoin has been, and still is, mispriced. Joe Consorti breaks down this disconnect on what Bitcoin did.
I think one of the things that's frustrated a lot of people is that obviously gold had an insane last 18 months or so. Silver has even, I don't actually know what silver's at right now, but it had a really good run before it kind of came back down. And the whole time Bitcoin was just sideways. And then as soon as everything turned over, Bitcoin got the volatility to the downside.
Yeah.
Why do you think it didn't catch any of that bid with the debasement trade, gold and silver stuff?
Yeah, so it's just a function of the market not understanding what Bitcoin is. Yeah, for a very long time, Bitcoin and gold were trading with about a 1 month lag. So, all the way back to, I think, 2019, it was pretty clear that moves that were made in Bitcoin, or gold rather, tended to be followed by Bitcoin with about a 100-day to 120-day lag. You could see on this chart right here, they were following one another, at least directionally, pretty closely for quite some time. This is a chart that Lawrence Lepard created over at the Bitcoin Opportunity Fund. And you could see, and if I adjust this a little bit more so that you can kind of see the better fitted to one another, this really started breaking down in October. And so what this tells me is that, debasement fear has been persistent. That hasn't necessarily gone away. That's what drove the rally in gold. But what drove the rally in Bitcoin in tandem with that, we're talking since like the 2023 bottom, is the fact that the Fed funds rate was coming down, that even though we were experiencing QT, the balance sheet was on its way to normalizing. So QT was on its way to ending. And so both of these trades were kind of happening at the same time as one another. And only one of those trades has continued, right? We had this decline in risk appetite, but gold and silver stole the show as far as investment capital is concerned because of the fears around monetary debasement. And also you have to think the speculative mania that happens when events like this occur cannot be understated. So obviously gold is a dinosaur of an asset. It is $30+ trillion in size. For it to be making moves that are adding multiple trillions of dollars of market cap within days and weeks, same thing goes for silver. That's something that catches a lot more headlines than one might think. And so it was both the fears of the debasement trade, but also this reflexive loop of people just trying to get in, buy this thing. You saw all of the Twitter posts of people waiting outside gold dealers trying to purchase gold, and that happened multiple times. And so really, the reason for the breakdown here in my mind is that we had a decline in risk appetite. If Bitcoin traded the way that its monetary properties allow it to, then it would have followed gold and would currently be well above $200,000 or even higher. But because it's more tightly correlated to things like software stocks, QQQ, other really high beta risk names in the equity market, then that's what's caused the sell-off here. So I think, looking at this chart, there are two schools of thought. School of thought number one is that Bitcoin will never be a debasement hedge. It's clearly failed. And school of thought number two is that Bitcoin is just severely mispriced relative to how it should trade. So if you look at this chart, this is even if it's not like an actionable chart in terms of making trades, one thing that it does do is it illustrates how wide this informational gap is. You and I both know, and chances are the listeners of this show understand, that Bitcoin performs all of gold's functions, but better. And so the only thing this chart illustrates to me is that we still have so much work to do in terms of narrowing that gap, in terms of educating people, and the market finally coming around to the reality that Bitcoin truly is digital gold and should trade like it.
Gold is treated as pure debasement protection. It sits outside the growth trade. Bitcoin doesn't, at least not yet. In the short term, it's still traded like a high beta liquidity asset. That means when growth stocks sell off, when software and global liquidity unwind, Bitcoin gets pulled into the same flows. Price isn't being set by belief, it's being set by marginal positioning. Over short time frames, correlations dominate. Over long time frames, Bitcoin's scarcity takes over. Those two realities can coexist. And right now, they do. That's why Bitcoin is best understood over a 5 to 10 year time horizon. It's an emergent monetary asset with superior monetary properties to gold. And the market simply needs time to catch up to that reality. Here's the key question. Is this derivative-driven volatility bad for Bitcoin? I would argue that it's not. All it does is it changes how Bitcoin trades in the short term, not what Bitcoin is. These mechanics amplify moves both ways. Downside gamma squeezes and upside gamma squeezes. And that's the bullish takeaway. If forced hedging can push Bitcoin down violently, the same system can force aggressive buying when positioning flips. And when that upside gamma squeeze comes, it won't be polite. All of this helps explain why this move happened, but it doesn't answer the question everyone actually cares about. Is the bottom in? Or should we expect more downside ahead? Some say this showed all the signs of a full capitulation event. Others look at historic bear markets and conclude we are headed down further over the next 4 to 6 months. On the Hurdle Rate podcast, this exact topic came up. Here's how it was framed by Matt Cole.
The entire market's getting a crash course in volatility right now, and none of it's clearly explained. The price actions all over the place. I think investors are just incredibly nervous in general right now, right? When you start seeing those moves, you're looking for something structurally that's breaking. And the scary part is, the markets have structurally been breaking for a long time now. It's just starting to get heightened at this moment in time. And you're starting to see things like inflation coming way down, and the Fed looks like they're kind of behind the curve on that one. Now we're in this no man's land kind of until, the next Fed chair is going to come in. So we've got this period of uncertainty here ahead of us of a few months. And so I don't think anyone should be expecting, market stability and calmness during that, right? Those are not the ingredients that typically bring calm markets. And I think it's confused a lot of investors. And then with Bitcoin not responding in the same way that the metals did, that was confusing to the Bitcoin community, right? Because everyone thought that when the metals move, Bitcoin would move right away, even though in the past we've seen that that's not how that's worked, right? That's not the path that it's taken. So we'll see what we've got in store here as we come into the summer, but I'm expecting a lot of choppiness and a lot of uncertainty and fear narratives that are going to creep up along the path here.
I completely agree, and it's why you'll never see me say the bottom is in, right? It could be, it might not be. If I look at historical time frames, like it would suggest that it's not, but also that it could be. And it just gets into like when you have a upward skewed asset like Bitcoin, you can't afford to be on the sidelines once the bottom is in. And so I think you just have to almost zoom it out and say it doesn't really matter and ask yourself to go to kind of Joe's checklist points of everything you think about Bitcoin, has anything changed? And the answer is no. Like, what were your theses in investing in Bitcoin?
So have we hit the bottom? Based purely on vibes, I would say yes, but I really have no idea. In the short term, we could head lower, but the long-term thesis remains intact. And all the data points to these current levels being historic accumulation zones. This is where perspective matters. Bernstein put it perfectly this week. What we are experiencing is the weakest Bitcoin bear case in its history. When all stars are aligned, the Bitcoin community manufactures a self-imposed crisis of confidence. Nothing blew up, and no skeletons will unravel. The media is back again to write an obituary. Time remains a flat circle on Bitcoin. The Financial Times already published its bear market obituary, in a piece I will never read, titled, "Bitcoin is still $70,000 too high." If you've been through more than one cycle, you've seen this movie before. Fear peaks, doubt dominates, and Bitcoin is once again declared dead or dying. You know how this movie ends. As the preacher reminds us in the book of Ecclesiastes, there is nothing new under the sun. And this pattern, fear, doubt, obituaries, recovery, isn't just a market cycle. It's cultural, which is why spaces that keep the signal clean actually matter. This is also why I want to quickly mention BitBlock Boom. Bitcoin conferences can be noisy. BitBlock Boom is built different. It's smaller, more intimate, and unapologetically Bitcoin only, focused on people who actually want signal and not just hype. Swan will be there this year, Corey, Brady, and the Swan Private team. So if you're planning to attend, use the promo code SWAN for cheaper tickets. If you care about understanding Bitcoin, not trading it, this is one of those few conferences that still gets that right. Moments like this are exactly why conviction matters. If fear and uncertainty is taking over for you right now, take a deep breath and remember why we're here. Look at the precipitous drop in married Americans who own a home by the age of 30. Look at inflation. Look at the relentless rise in the cost of food and shelter, and how your wages are keeping up. The system isn't working the way it was promised. Bitcoin isn't a trade. It isn't a meme. It isn't a fad. It's a response. An honest ledger in a world of distorted incentives. So in closing, there was no big catalyst for this crash. Nothing collapsed, and nothing fundamental broke. What changed is how Bitcoin is being integrated into the financial system. Bitcoin is no longer just an outsider asset reacting to belief and sentiment. It's becoming a global monetary asset that capital trades, hedges, and builds structure on top of. If Bitcoin was ever going to dominate as money, this was always going to happen. And that transition doesn't reduce volatility. It changes where it comes from and who it transfers conviction to. This wasn't a failure of Bitcoin, it was just another step in Bitcoin's real-time monetization process. Be thankful you get to be along for the ride, and that you're here before the majority of the world. So I'll leave you with two questions. Do you think this crash was driven more by structure or by psychology? And more importantly, has your Bitcoin thesis actually changed? If this video helped you think more clearly about this crash, don't forget to like this video and share it with someone who needs it. And subscribe to the Swan Bitcoin channel for more high signal videos like this. Thanks for watching, and remember, in the competition of money, there is no second best.